Hey everyone, between April 23 to September 24, Indian equities were among the best performing market in the world. But since then, everything flipped. India has become one of the worst performing equity market globally. On the other side, US Nasdaq index is up by 20%, Chinese stock market is up more than 15%, Taiwan stock market is up more than 15%, German stock market is up 24-25%. In fact, South Korea stock market has outperformed big time with 35% return. Okay, let me clarify that the underperformance of Indian stock market is only in last 1 year. If you look at the bigger picture of last 5, 10, 20 years, Indian stock market is one of the biggest outperformer. And I strongly believe that Indian stock market would continue to outperform in next 5, 10, 20 years. The biggest reason is because we are the youngest and one of the fastest growing economies in the world. Having said this, the underperformance of Indian stock market in last 1 year has raised one important question. Is it worth diversifying your portfolio with some exposure in the global stock market? And the answer is absolutely yes. Not just because the Indian stock market is underperformed and global markets have outperformed in last 1 year, but because global investing helps us getting exposure in some of the world's best companies like Apple, Microsoft, Nvidia, AMD, Tesla, Alphabet, Amazon, or even likes of Toyota, Samsung, Taiwan Semiconductor. These are the companies that are global leader and are shaping the next decade of technology like AI, semiconductor, EVs and so on. Another reason for global diversification is it helps in reducing geography concentration risk. Although India is a very stable economy, but what if India faces a macro slowdown or political instability or let's say external shock like oil price, monsoon, trade war, then your entire portfolio suffer. Or for that matter, overvaluation as compared to growth. There's no doubt that India is the fastest growing economy, but there's a limit to what you should pay for the growth. In fact, the single biggest reason why Indian stock market has underperformed in last 1 year is due to overvaluation. Due to sharp rally between April 23 till September 24, Indian market became very expensive. Then third benefit of global investing is currency depreciation. Over time, INR is depreciated against USD. So when you invest in US market, you also get the benefit of USD appreciation over and above the stock market return. Hence, it makes sense to have some global exposure. But then there are multiple questions. How much global exposure is enough? And where to invest? Should you invest in US market that hosts the most innovative companies of the world? Or should you invest in developing economies like Taiwan? Or should you invest in China, which is the next big economy after US? And finally, how do you invest? See, global investment from India is not that straightforward. One of the biggest challenges, $7 billion cap on total overseas investment by Indian mutual funds. Another issue is taxation complexity. Then there are high costs involved including your currency conversion fee and so on. But recently, Gift City is addressing these challenges and trying to make global investing easy. So we'll deep dive into all the options of global investment from India, be it direct stocks, mutual funds, ETFs, and then we'll discuss their pros and cons. And finally, we'll cover the global investing via Gift City and how it can help Indian investors. Alright, let's get started. Let's start with the first question. How much global exposure is enough? To be really honest, it really depends upon your investment goal and your comfort level. Personally, I look at global investing as an option to diversify my portfolio so that there is no 100% dependence on India. So that in case India faces a slowdown, your portfolio isn't hit entirely. Then another reason is to get access to world's cutting-edge businesses across AI, cloud, EV, semiconductor that are not listed in India. In short, I would still prefer 75 to 80% exposure in India for growth and remaining 20-25% exposure in global market for portfolio balance and innovation. Now let's discuss where to invest. On one side, you have US that hosts some of the most innovative and profitable companies in the world. The likes of Apple, Microsoft, Nvidia, Amazon, Alphabet that have been the backbone of global AI and technology revolution. Then you have countries like Taiwan, South Korea that dominate the semiconductor and electronic supply chain. Or maybe even China that despite all its challenges still remains the second largest economy in the world with huge manufacturing base, growing domestic consumption and increasing focus on EVs, batteries and green energy. So it's a debatable topic in terms of which country you should really invest. But for me, since the goal is A, diversification and B, investment in world tech leader, I would prefer investment in the US market. Another reason is we already use the product and services of top US companies that dominate across the world. So it's easier to connect. Now let us look at all options for global investment from India. So broadly, there are three options to invest globally from India. First option is individual stock investing under LRS, that is Liberalized Remittance Scheme. RBI allow resident Indian to remit up to $250, that is around 2.2 crore rupees per financial year for global investment. Here the first step is to open a brokerage account with a global brokerage platform in India. For instance, you have platforms like IND Money, Vested, Kuvera that act as Indian intermediaries where they link your Indian bank account with your US investing account. So when you transfer INR from your Indian bank to the platform, they convert INR to USD, usually at competitive forex rate and a small fee. Your funds are then held in a custodian account in the US, which is often a US brokerage partner like Dry Wealth or Apex. Basically, you don't need to open a US bank account. The platform handles custody and execution. Please note that these platforms currently focus on direct US stocks, but they also have ETFs on their platform that allow exposure to Taiwan, Korea, Europe indirectly. Now, if you look at the benefit of stock investing, the biggest benefit is direct ownership. You own the actual company shares and you can decide which company to buy at what price. But the catch is you need to have the right knowledge before investing your money. And that requires a lot of active tracking of global economy, the risk, volatility and so on. And the fact is, it's not easy to track individual stocks. For example, Tesla is known as the pioneer of EV revolution in the world. But look at the crazy volatility in its share price. It's not easy to hold your nerve when the stock tanked 40-50%. Then another catch is higher cost and taxation. There are currency conversion charges, transaction fee per trade and annual account maintenance charge. So it's not cheap. Plus, taxation is very tricky part. First of all, any dividend you receive from US company is taxed at 25% TDS in the US before it reaches you. But the good news is, India and the US have double tax avoidance agreement. So you can claim that 25% as a credit while filing your Indian ITR. Second is your capital gain tax. If you hold the stock for less than 24 months, it is considered short-term capital gain and taxed at your applicable income tax slab. If you hold for more than 24 months, it becomes long-term capital gain taxed at 12.5%. Now this taxation is higher as compared to investment in Indian equity, where if you sell equity within 1 year in India, it is taxed at 15%. And if you held for more than 1 year, then it is taxed at 10% on gain above 1 lakh. But this high tax does not necessarily mean that you should avoid global investing. The purpose of global investing is diversification, not tax optimization. That said, you should be aware of this taxation complication of direct investing. However, if you don't want the hassle of direct stock investing as well as your currency conversion, taxation and so on, you can explore option 2 and 3. Let's have a look. So second option for global investing from India is via Indian mutual funds or ETFs that invest in global market. As compared to direct stock, mutual funds or ETF route is hassle-free, where you don't need to take the headache of identifying the right companies. Just buy the ETFs or mutual fund and you are sorted. Essentially, they are fund of funds. For example, you have Motilal Oswal Nasdaq 100 fund of fund that invest in Nasdaq 100 index that include top 100 companies of US like Apple, Microsoft, Nvidia and so on. Now when retail investor invested their money in this fund, it actually goes into the Nasdaq 100 ETF. That's why it is called fund of fund. Then you have Edelweiss US Technology Equity Fund of Fund. It is a thematic fund that invests in JP Morgan US Technology Fund. It means you get exposure to technology companies of the US beyond Magnificent 7. In case you want exposure in Chinese stock, you can explore Axis Greater China Equity Fund of Fund or Edelweiss Greater China Equity Offshore Fund. Now some people are more comfortable with ETF as compared to mutual fund. So there are a few ETFs as well. You have Motilal Oswal Nasdaq 100 ETF. Then if you want exposure only in top US tech companies, you can explore Mirai Asset NYSE FAN Plus ETF. That is made up of 10 high growth technology, internet media, electronic vehicle names that include Apple, Amazon, Meta, Microsoft, Alphabet, Nvidia, Netflix and so on. But there's a catch. The RBI has capped total overseas investment by Indian mutual funds to $7 billion. That's why many global mutual funds have temporarily stopped taking new inflows when the limit was breached in 2022. Later they reopened it when redemption resulted in freeing the cap space. But based on capping, they keep closing the investment option. So if you want to invest in these global funds, Do check scheme latest fund document or let's say AMC notice to see if they are accepting fresh subscription or they are close to new inflow. Or you can use your mutual fund platform app to try to place a lump sum or SIP order. Often it will show not available if the fund is closed. You can also monitor news or AMC announcement. Sometimes fund reopen when redemption free up cap space. Also please note that when it comes to ETF, due to overseas investment cap and limitation on how many fresh units these ETFs can issue, sometimes the demand is more than supply. And that results in ETF trading at a premium over its indicative NAV. To cater to problems like unavailability of scheme to accept fresh investment due to RBI capping, there is a third option. Let's have a look. So third option is investment via GIFT City, that is Gujarat International Finance Tech City. It is emerging as a hub for global investing from India. So one of the biggest advantage of investing from GIFT City is there is no $7 billion capping by RBI. It means you don't have to worry about mutual funds not accepting your investment. Second benefit is GIFT City offers a more streamlined and cost-effective approach for global investment that minimizes your currency conversion expenses and all associated risks compared to traditional fund of fund route. Now, there are several global and Indian brokers that are opening up their operations there. The first global fund was launched by DSP in recently June 25 under the name DSP Global Equity Fund. This fund holds 30 to 50 stocks across world including companies from US, EU, Japan, Hong Kong, South Korea. They can also consider companies from emerging market. Please note that there is a minimum investment capping of $5,000, that is 4.5 lakh rupee. So it won't be possible for every investor to consider investing in DSP Global Equity Fund as of now, and its expense ratio is around 1%. Currently it is in nascent stage, but in near future many funds are expected to launch funds in GIFT City. Please note that taxation at GIFT City is treated like any other international investment. If you withdraw in less than 2 years, it is taxed as per your tax slab. If you hold for 2 years, it is treated as long term at 12.5%. Now you might ask how to invest via GIFT City. So at the moment, I don't see brokers like Grow or Zerodha providing investment option via GIFT City. But you can invest directly from Fund House website. For instance, DSP has provided the steps like you need to fill the application, then submit the document physically to GIFT City office, and then your folio would be created. So it's a little tricky process at the moment. Hopefully, it will get simplified over time, but worth tracking closely. So in this video, we discussed why having some global exposure makes sense for Indian retail investors. It is not only to provide diversification to reduce geography concentration risk, but also it gives an opportunity to invest in world's most innovative companies. We looked at 3 investment options. First is direct stock investing that offer ownership and control but comes with higher cost, tax complexity and require constant monitoring. Second option is global mutual funds or ETF that are simpler and hassle-free but limited by RBI's $7 billion overseas investment cap and may close to new investors at time. Then third option is GIFT City Fund that provides direct access to global fund, remove the RBI cap, reduces currency conversion cost and simplify the process. Though currently it requires more effort and higher minimum investment. Over time, as more brokers and platforms participate, investing via GIFT City will become even more seamless. So the key takeaway is maintain a strong India allocation for growth while strategically allocating 20-25% of your portfolio to global market for diversification, innovation and long-term wealth creation. And remember, don't get carried away just because Indian markets have underperformed in last 1 year. Start small, keep a long-term horizon and diversify systematically and let your portfolio work across borders. Now tell me in the comment, do you invest in global market? If yes, which route do you prefer? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.